Hello and welcome to Crux Investor. We caught up earlier today with Spencer Cole. He's the EVP for North America for Vox Royalty. We talked to him about their plans post their 16.85 million raise. They've got 12 LOIs currently outstanding. And we talked to them about when they intend to close them, and if indeed they can close them. Great conversation, great romp through the management team's relevant experience, their cash and cash position, how they like to differentiate themselves from the opposition, and what their plans are for the rest of this year. If you want our thoughts and opinions on this company, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. There are commentaries from experts from around the world on a variety of companies, commodities, and royalties. We've got training courses on there to help you with your due diligence process. We do summaries of interviews, in fact, all of our interviews, just to save you some time, because we know you are busy. And more importantly, if you want to join a thriving community of investors sharing their thoughts and ideas with each other in a nice, safe and friendly environment, free from judgment, trolling and abuse, go and join them at cruxinvestor.com/club. I think you'll really like it. And we'd love your feedback too. So give us a like, it'd be appreciated. If your thoughts below, get back to everyone. And if you want to see precisely what we talked about with Spencer, take a look in the description below. Spencer, how are you, sir?
Very well, thanks, Matt. How are you doing?
I'm hanging in there, if I'm honest. Following my COVID jab this week. But I'm okay. I'm not going to complain about it. So where are you speaking to us from?
I'm in rainy Toronto.
Lovely.
So just
lovely.
Yeah, it's starting to get a bit warmer, and patios have just opened up, so it's not all gloomy here. But we're surviving.
Good. I'm glad to hear it. Well, look, thanks for joining us. We're going to hear the Vox Royalty story from you this time. We've actually interviewed one of your colleagues, Kyle Floyd, who is, what is he? Is he CEO?
CEO and chairman.
Chairman. What are you?
Executive Vice President for North America.
Righty ho. Okay, so we're gonna hear your version of the story as well today. Look, why don't you kick off? Give everyone a 1 minute overview, just to remind people who perhaps know you or don't know you, what it is that you are, and I'll take it from there.
Sure, absolutely. So Vox Royalty has been around for 7 years, but we've only been listed for 9 months. Vox is a precious metal focused, high growth royalty company focused solely on the acquisition of existing royalties, so not originating new royalties, where over the last 2 years, we've led the industry in growth. We've completed 19 separate royalty transactions, and our portfolio of 47 royalties is heavily weighted towards Australia, where we are the second largest holder of hard rock royalties, second only to Franco-Nevada.
Is your accent a clue as to why you focus on Australia, or are there better reasons than that?
Yeah, apologies to the listeners for my unfortunate Australian accent. So 3 out of our 4 key management team members are Australian citizens, for better or worse. But also, I think, we're heavily skewed towards Australia just because we view Australia and by extension, Western Australia as one of the best gold mining jurisdictions on the planet. And so we've been successful in developing a first mover advantage, particularly in Western Australia.
Right. And do you think you've got the business model right? Because when we've been interviewing various royalty companies over the past couple of weeks, they've all got slight kinks and differences to them. They like to think they're all unique. I mean, what's so special about your model?
Sure. So I think one thing that really differentiates us from the competition is over the last 10 years, we've developed what we believe is the world's largest proprietary royalty database, which is approaching 8,000 unique hard rock mining royalties. And so we use that intellectual property to, I guess, high grade a really attractive and accretive opportunity set for our shareholders. And the overwhelming majority of opportunities that we source through that database and our deal sourcing networks are deals that we call bilateral deals. So just us and the royalty seller, without any brokers or investment bankers involved in those deals. So I think that intellectual property and also augmented by our technical team, because our management team is comprised of mining engineers and geologists, makes us quite a differentiated royalty company.
Okay, well, yeah, I want to talk about the team in a second, but let's just stick with the database here. So you've got 8,000 bilateral royalties. So is that the right phrase?
So by the end of this year, we'll have over 8,000 in the database.
Right.
They are individual royalties, like third-party royalties that could be transacted upon.
Right. Are you trying to say that no one else knows about these, or they're out there, but you've kind of aggregated them and put them in one place?
We're certainly not saying that our competitors are blind to all 8,000 of those. They may have visibility around a subset of that. But what we're very confident on is that no one has the full extent of that database. And also, Matt, I mean, for us, the proof in that the size and quality of that database is that we consistently find ourselves as the only buyer at the negotiating table with royalty sellers.
I mean, isn't it better to have people with relationships with companies or access to networks? That seems to be what I've been hearing the last week or so.
Yeah, I think it depends on what your business model is. There are other royalty companies that focus on project financing and originating new royalties. That's not our model. We've back tested over 600 royalty deals that have cleared the market over the past 40 years. And what that benchmarking and back testing has consistently shown is that the greatest alpha for shareholders is in acquiring existing royalties. There's a natural adverse selection bias when you're writing new royalties over projects, typically because they've tapped out on equity and debt capacity. So based on that back testing and our own transactional experience within our management team, because we've been buying and selling royalties for the last 10 years, that's why we're firmly focused on existing royalties. And in the existing royalty game, I think the relationships are less focused on the mining companies or speaking to management teams of different listed operators, and it's more focused on, can you find that prospector out in the bush near Kalgoorlie, or can you find that doctor who holds an interesting royalty in a remote village in West Africa? Those are the relationships that we invest in.
Right. Okay. You've recently raised $16.85 million. Not sure the market liked that for some reason. You've gone from $3 down to $2.62. What's your take on that?
Yeah, I guess as with any capital raising, there's obviously some investors that weren't thrilled about us going back to market. We've only been listed for 9 months, but I think, as I mentioned, we've led the industry in terms of acquisition growth, and it's not just a volume game. We've been putting up deals at really compelling prices. So, if you look through some of the marketing materials that we shared as part of this financing, it's funding a really attractive portfolio of bilateral deals that we've locked in under LOI. So I think some investors may be disappointed we're tapping the market so soon after going public. But for those that go through our marketing materials and see the deals that we have locked in, that this financing will be funding, I think there is a huge amount of value that's going to be unlocked through this financing. So we certainly hope that this is just a short-term overreaction.
Okay, so you talked there about what you're going to do with it. You've got 12 LOIs. I mean, LOIs, they're not binding, are they? They don't mean anything really, do they?
Yeah. So historically, our conversion rate of executing and completing on LOIs is extremely high. We typically don't paper up any deal until we have some sort of verbal alignment and verbal agreement from the counterparty. So yes, there's always confirmatory DD that could derail a certain deal, but historically we've completed the overwhelming majority of deals we had under LOI.
Right, but they all have different terms attached to them. So, but I am right. There's nothing binding in there. It's just you have a expectation to be able to close them. Is that right? Yes,
there are aspects to our standard LOIs that are binding insofar as, I guess, exclusivity and confidentiality. So, when we work with any royalty seller, there's an agreement in both implicitly and in writing that we're both working together in good faith exclusively. And if one party breaches that, or if the seller decides to try and shop the deal around once they've executed the LOI, then there are I guess financial repercussions for that.
Yeah. Okay. So, but you're not counting on any of those. There's clearly no implied value of the LOIs being trying to be attributed towards the company as it stands today. None.
No, we haven't completed those deals and haven't announced them. Like we expect we hope to announce some of them in the next couple of weeks. So I guess then the market will be able to sort of assess the quality of those deals.
I only ask because we spoke to one company which was in the same position on one asset, and they were claiming the revenue on an asset they hadn't yet acquired.
No!
I just wanted to be really clear with you.
No. Until we fully own an asset and we complete on a deal, fully papered up, it's the seller's asset. It remains the seller's asset. So
okay, so I want to get into the company proper. I want to start with the management team. How many royalties have you transacted on as a team?
So our portfolio is 47 royalties. That's sort of the Vox portfolio. So that's what we've built as Vox. Prior to that, in our prior lives, over the last 10 years, management collectively has been involved in over 1.5 billion in royalty transactions, either on the principal side, on the sell side advisory side, or somewhere in between. So in total deal number royalty deals we've been involved in would be in excess of 50 as a team.
Right. Using a similar type of royalty structure as you've got now in terms of being able to negotiate similar royalties to the model you're employing today.
Yeah, that's royalty deals that we've collectively worked on, specifically transacting on hard rock mining royalties.
Okay,
so exactly what our business model is today.
Great. Yeah. Okay, so you know what you're doing in terms of the paperwork. Okay, technically, again, who on the team technically is responsible for assessing the types of deals? Because again, it can be easy to do the paperwork on deals, but they may not amount to anything economically. So who in the team technically assesses these things?
Absolutely. So our team, so Simon Cooper, who's our head of business development, he's both a mining engineer and a geologist. Rian Esterhuizen, who leads our Australian business out of Perth, he's a renowned exploration geologist who's worked with some of the who's who of large cap mining companies. Myself, I'm a mining engineer and reformed investment banker. And Kyle, he had a brief stint at Colorado School of Mines, but we probably wouldn't put him into the fully technical bucket.
Right. Okay. And again, I'm just trying to understand your ability to create value for shareholders. I get you've done a lot of deals, but can you sort of talk to us about where you have created value in the past for shareholders?
Sure. So if you look at our portfolio of 47 royalties, Matt, we've deployed about $25 million to create this, $100 million company. So I guess that's sort of one, objective value creation metric. I think the other way to look at it is, I guess, from terms of a rate of return on the portfolio that we have today. Brokers have our top line revenues going from $2 to $6 to $8 million sequentially, based on the 47 royalties that we have today. So I guess if you work through that revenue line on $25 million deployed, that gives you a sense for roughly what type of value is being created as we allocate capital.
Right. I mean, you sort of answered this previously because we've talked about the database, but I'm just trying to understand how you are differentiated or what your competitive advantage is with all of these royalty companies which are coming out of the woodwork. Okay, so there's lots of new royalty companies coming out, and we've interviewed a few, and some, even some that we haven't, that are of a certain size, of a certain level of expertise and experience. You're still going to have to compete against them in terms of the white noise. So are you relying entirely on the database to differentiate you? No,
absolutely not. I mean, the database isn't a sausage factory that just churns out deals. The database is obviously a living, breathing thing that is expanding by the day, but it still needs, I guess, to be used in the right way. And, knowing where a deal sits and knowing how much, what the royalty rate is and, how much of the ore body it covers is one aspect to getting a deal done. There's a huge amount of softer aspects in terms of, actually how do you negotiate and get the deals done, particularly with a very disparate set of counterparties. We've bought royalties from prospectors out in the bush, technology companies, and then, major mining and commodity trading companies as well. So some of the softer sides of how you actually get deals done. And then a lesser known part is actually how do you actually get in front of the royalty holder, particularly when you're dealing with, say, a family office in Latin America or, a doctor in West Africa. A lot of these individuals and selling groups, you can't just pick up the white yellow pages or equivalent. So you need to have agents in country to be able to actually, contact these groups. So that's another part of Vox is, I guess, our in-country deal sourcing networks that help us actually get these deals done.
Right. Okay. So if I look at, you've told us how many, you've got 47 royalties. That's all well and good, but the kind of name of the game here is making money. So, you need cash producing assets as quickly as possible. So how many of these assets of yours are materially advanced? And by materially advanced is will be you producing cash for you in the next couple of years?
Sure. And I think that's the right question to ask, because it's certainly not a numbers game. So we went public with one producing asset, and we finished last year with 4 production stage assets. We have a few additional royalties coming on stream this year. So we expect to finish this year closer to 7 or 8 producing assets. There's an outside chance we could finish it closer to 10 based on some acquisitions. But when we look at our portfolio, there's approximately 20 royalties that have some level of engineering work that's been completed on them, such that, we can model the discounted cash flow profile of those assets. So that's broad way of saying, we've got line of sight around potential cash flows from about 20 assets, but near term, we expect that, about 10 of them have strong potential to be in production.
Right. So we're talking about, if it's North America, we're talking about 43101s. In Australia, where most of your assets are, or most of the royalties are, JORC compliant resource numbers are needed. And then the company needs to give you a good indication of how quickly they can move forward, that they've got the capital, that they've got the ambition to do it within that period of time. How do you gauge that? Because not all mining companies are, completely, honest about the actuality of a situation. Things slip and so forth. So how do you forecast?
Yeah, it's a good question, and as you know from your prior dealings, this valuation is more of an art than a science. So I think we try to ensure that we never fall in love with assets, and we have very robust debate and heated debate within our management team about how to allocate capital to different potential deals. I think ultimately we look at assets that that have been materially de-risked in terms of the usual pitfalls. Is the metallurgy, has the met work been done on a representative sample of the ore body? Has there been a sufficient amount of drilling done? What is the ore body, the actual geometry? Can this readily be mined? And then I guess from a corporate perspective, has this operating team that controls the asset been there, done that before? Can they actually raise the financing to get this project up and running? Because one thing we see consistently in the industry, in the royalty industry, is people buying royalties over large ore bodies that frankly are a little bit sleepy. So the original feasibility study might have been done 20 years ago, which should be quite telling that project's not moving ahead in a hurry. So I guess we look through both the technical aspects and the actual corporate or operator aspects of any royalty asset and focus on royalties that have strong and de-risked near-term catalysts that will move the asset forward to cash flow for our shareholders.
Right. Okay. So again, what you've got to try and do is help me understand the number of gold equivalent ounces that you've got in terms of resources, reserves, ounces in the ground where you directly have a royalty over, because I'm assuming that the royalties may not apply to the entire resource number that the company puts out. So again, how do you go about gauging that? Yeah,
no, it's a good question, Matt. So the majority of our Australian royalties cover the entirety of the ore bodies. So I think that's just by way of how the royalties have been created. Typically, it's a junior explorer has made a discovery and taken it to, say, pre-feasibility stage and then sold the entirety of the project onto a larger developer or producer. Some of our North American royalties only cover part of the ore bodies. So, when we report resource estimates or when we disclose new deals, we're very clear to say this only covers part of this ore body. For us, it's not a, headline catching game. So going back to your question, across our portfolio, we have on a gold equivalent ounce basis, we have, royalties that are linked to over 10 million ounces of gold. And that's when I say linked to that gold equivalent resource, I mean specific really a royalty covered resource, not, it's a 2 million ounce resource and then we've got a tiny fraction in the corner. So, but I think the only nuance I'd say to your question is we're focused on cash returns for our investors, not on land banking large ore bodies and large royalties.
Okay, so but with that number, is that within the next 2 years, that number, or is that the entire kind of royalty package?
So that's the entire sort of mineralization that is covered by a royalty claim or tenement.
So what can we expect to see in the next couple of years? Just give us an ounces, dollars, and however you want to give it.
Yeah, so the street has us going from $2 to $6 to $8 million in top line revenue, and so when you work out that on a gold equivalent ounce production basis, broadly speaking, it goes from about 1,000 ounces to about 3 or 4,000 gold equivalent ounces, and then up towards about 5, and that's just based on what's in the portfolio today.
Okay, and these all private companies? Sorry, all public companies, or are there any private companies in there?
Out of our 47, there's about 5 or 6 private companies, but they're skewed more towards our earlier stage properties. So the overwhelming majority of our properties are held by large listed operators.
Okay, the only reason I ask is obviously it makes it harder for you and anyone else to actually get a gauge on the numbers because it's not public. Which kind of goes to the next question, which is in terms of these royalties being materially advanced. I mean, again, do you know how many meters are being drilled in the next couple of years?
Yeah, absolutely. So in the last quarter alone, we had about 34,000 meters of partner-funded drilling specifically on our royalty claims. So not, I can give you examples where, one of our projects, Bulong, the operator has drilled 60,000 meters in the last 6 months, but of that, approximately, a quarter of that is on our royalty claims. So when I say 34,000 plus meters of drilling, that's specifically on royalty linked claims. So, we're at an annualized rate going forward of about 130,000 meters of partner funded drilling on our specific royalty claims.
Right. Okay. I think that's really important to understand. I'm impressed, the numbers, quite frankly, because we keep saying this is about cash and cash flow, and I get you talk about cash and cash returns for investors, which is all admirable, but you got to deliver it, right? So, and some of the conversations I've had this week have me guessing somewhat. So, can you give me an idea of what your cash flow is like now? I know you just raised some money, but what's your cash flow like now? And what's that kind of cash growth profile look like going forward?
Yeah, sure. So I think that was one criticism when we went public, Matt, was that, hey, you've only got one producing asset, and your cash flow profile is fairly anemic. So part of that is because we consistently find the deepest value when we acquire royalties that are, call it 3 months to 24 months from first production. So we've naturally built a portfolio that is at this sort of the start of a hockey stick in terms of the number of assets that are coming online and the associated cash flows that come from that. So later this year, we have 2 key operations that are expected to come into production. Next quarter, it's the Segilola gold mine in Nigeria that we have a royalty over. And then Q4, the Bulong gold royalty in Western Australia is expected to commence production. So those 2 assets coming on stream will make us finish the year at, call it about $2 to $3 million in annualized revenue rates. That's so based on those 2 incremental operations. And then as we look ahead to the following year, we've got a number of other operations that we expect have strong potential to come on stream over that year, which would bridge you closer towards analysts' expectations around that sort of 5 or 6 million.
Is any of this falling off? Because again, I'm interested in the sort of duration of this cash flow. Because we've talked to companies this week who've got very short life of mine projects, which they've got royalties on 2-3 years type of things, which they have an expectation, which will always be 2 or 3 years, but that isn't always the case. So again, what's that profile look like for you? Yeah,
sure. So full disclosure, we've got a combination of short life and long life assets in our portfolio. So, we've got 7 assets in our portfolio that have 10 plus year mine lives. and a number of those, we expect to come into production over the next few years. So if you look at our current cash flow, so we've got an iron ore royalty, Coolionobbing, that's, the current reserve life on that is about 7 years. Resource life is closer to about 15 years. And then if you look at some of our other producing assets, they're in that sort of, call it 5 to 8 year mine life. But I think where the real talk comes for investors in terms of what's in the Vox portfolio is there's a number of other operations that are feasibility stage or currently being mined, but they're transitioning onto the royalty areas that will extend that weighted average mine life, into the sort of 10 to 15 year bracket.
So this might be a bit too hard to answer, but what does the cash flow look like, on a reserves only basis versus resource? Is that something you guys calculate?
Yeah, so it would probably be on a reserves only basis. It would probably be, closer to, call it 5 to 8 years. Right. But frankly, I think that's, if you look at the Franco-Nevadas of the world and the grandfathers of the industry, that's frankly not a realistic metric that has played out for any royalty company. So with the size of the land packages where we have royalties over, like if you take our Bowden Silver project in New South Wales, that just in the last week they applied for their mining leases. So moving towards construction, that total land package is approximately 1,000 square kilometres. So to assume that, the mine life on that asset is 16 years, but there's potential further beyond that 16 years because just the sheer size of the land package. Mm-hmm. So, yeah, it's a long-winded way of saying, not sure if reserve life is the best way to value royalty companies.
Right. Okay. And again, for people perhaps watching this for the first time, a royalty interview for the first time, perhaps not considered royalties before, the difference between organic growth and M&A is what?
So organic growth, our investors get for free. So when we look at every month, we're gifted with a huge amount of positive news flow on our 47 royalty assets from our 40 operating partners. So whether that's 130,000 meters of drilling, or if that's exploration stage royalties that have feasibility studies coming out where you can point to the cash flow potential. We've got 3 royalty assets that we each bought for between $50,000 and $100,000 that in the next 6 months we'll be releasing engineering studies. So straight away we'll be able to point to, we paid $50,000 or $100,000 for these exploration stage royalties, but they've now matured into development, and the potential revenue profile could be 10, 20, 30x, what we've essentially paid up front. So organic sort of growth is all that free. It's like a wine cellar. It's the wine cellar you own today that just appreciates in value as the operators spend money developing the projects, and obviously expanding production stage royalties that continue to expand production. And then acquisition growth is obviously the more capital intensive growth, where we're actively working out, our database and our deal sourcing networks to acquire, accretive and high rate of return incremental royalties to bring into our portfolio of 47 royalties.
Right. So the organic component is important to you and other royalty companies because it's cheaper. Not so much, and it's not so much up front. Well, yeah, de minimis number attributed to it. What's your track record and experience, and how on earth do you influence companies to behave a certain way just because you've got a royalty over them?
Yeah, I think, to be perfectly brutally honest with you, Matt, being a royalty holder, and I think most honest royalty company executives will tell you this, when you're a royalty holder, your ability to influence the operator is pretty close to zero. All you need to do to be successful as a royalty holder is, when you're securing or acquiring the royalty up front, you just need to be damn sure that the royalty you're buying, because it's essentially just a piece of paper, is going to be valid and recognized by the operator. So we have really constructive dialogue with a number of our operating partners, when they give us up-to-date drilling information and guidance around when certain assets are going to be, advanced. or in the case of our producing assets, how production's evolving. But the unfortunate reality is we're buying a derivative investment linked to their operation. We are not the operator influencing the operation.
Right. Again, why this interests me from what I've been hearing over the past few weeks, what I've learned over the past few weeks from research is, how can you, or what point do you start to include the organic numbers into your numbers? Do you need, I know you said you get sort of some kind of line of sight, but you have no influence or control. They can change in a moment's notice. So how far out do you look? And it's in the context of a statement I heard from a royalty CEO who was claiming revenue for something which doesn't even, in the next 2 years, which doesn't even have a resource, which intrigued me. So being in the head frame, in the shadow, next door to neurology, all of that, I personally don't put any value on, but some royalty companies do. How do you guys get away with that?
Yeah, look, I think that's not an interpretation or a position that we would take. We typically aim to buy royalties on projects that have an existing resource estimate on them. So, they might have a historical resource or a current JORC or, NI 43-101 resource on them. And then, for internal modeling purposes, when we're doing due diligence, we might, build out our own operating assumptions to say, what could this potential operation look like? But we'll never provide guidance or release to the market cash flow forecasts unless there are hard engineering studies that sit behind that. The only nuance to that, I would say, Matt, is that ultimately our role for our investors is to seek out and capture the best risk-adjusted returns through mining royalty investments. And so we will take positions on earlier stage projects where we see that there's low execution risk. So, for example, 3 weeks ago, we announced a deal to acquire 3 early stage gold royalties in Western Australia. Tiny deal compared to our competitors. It's a $300,000 deal. But what we really liked about those 3 gold projects was each of the 3 actively being drilled. One of them has a resource of about 100,000 ounces of gold on it. And importantly, from an execution risk perspective and from a future cash flow perspective, each of those 3 assets are within trucking distance of a third-party processing mill. So for our investors, they're getting a very cheap sort of lottery ticket, for lack of a better word, on a project that is substantively de-risked because it could be a potential source of gold ore for an adjacent processing mill. So we won't forecast those cash flows publicly, but certainly internally, we're trying to maximize those risk-adjusted returns for our shareholders.
So what does your organic profile look like for the next 12 months then?
So I'll break it into 3 components: producing, development, and exploration. So on the production front, we expect organically to increase from 4 producing assets to 6, with some surprise to the upside potential above 6. But 6 that we can definitively point to. And then from a development perspective, as I mentioned, we've got 3 exploration stage royalties that are just about to release feasibility studies and PEAs in the next 6 months. So they'll mature into that development bucket. And then also, from an exploration stage perspective, we expect to be at sort of, call it 120, 130,000 meters worth of partner-funded drilling on our exploration properties, with a number of resource updates and maiden resource estimates expected to be released on those exploration properties this year. So each month, investors should expect just a huge amount of free organic news flow across each of those 3 buckets of royalty assets.
Okay, interesting. What do you think if you look at organic versus transactional growth for this year, what's it looking like?
Yeah, so what we announced to the market as part of our financing last week was that we have a number of deals under LOI. So we're working through those at the moment towards completion. So I think investors can expect us to continue to make sensible acquisitions and at disciplined prices. So we would expect to be announcing a handful of deals over the coming months, and subject to what comes down the pipeline, because at any given time we have, call it 20 to 40 different term sheets out on different assets in the market. So we would expect that the remainder of this year to be a very strong acquisition growth year as well. But, focusing on value rather than just volume.
Okay. Value, accretive. There's so many sort of buzzwords that you guys use. I'm not quite sure what they mean. So what does value or accretive mean to you, your organization? What does good look like? What's good look like?
That's a good question, Matt, because we've seen the word accretive thrown around like confetti.
Oh yeah.
In the junior end of our industry. I think an accretive deal for us is really a deal that has a above average or meaningful rate of return on all key sort of metrics. So it adds value on a net asset value perspective. So if we're trading at 0.9 times NAV, and if we're acquiring an asset for 0.4 or 0.5 times, that's adding value on a net asset value basis. And then from a cash flow basis, where obviously, the rate of return we're getting based on our cash outlay. So, for example, we bought a royalty over part of the Higginsville mine last year, in May of last year. We paid $650,000 for that royalty. That royalty is now generating $200,000 to $300,000 per annum. So, the cash return on that cash investment, that rate of return is accretive relative to our cost of capital. And then I guess, you can look at all other multiples such as cash flow multiples, where we're paying less per unit of cash flow relative to what we're trading in the market. So we would typically look at those three metrics in terms of what is truly accretive, being net asset value. We're paying less than we're trading at. Cash flow multiple, same story. And then cash on cash return or return on investment. That's, that rate of return is well in excess of our cost of capital. So that's what accretion means for us at Vox.
See, the interesting thing in your sector is because you guys seem to get extraordinary multiples compared to miners. It feels like some royalty companies just do deals just for the scale because they know they're going to get a 15, 20 times uplift. Because it's just about doing deals. The market gives them credit for it, whether the deal's expensive, whether it's going to make them money, because it all gets rolled into one. It just gets packaged into one big bundle, and hopefully no one lifts up the skirt and has a look. Is that fair to say?
Yeah. I think there are a number of newer royalty companies that are trying to just play the multiple game. And if your only competitive advantage, so to speak, is a multiple that the market is ascribing to your equity value, and your only truly differentiated lever is a lower cost of capital. I think that's a pretty shaky foundation to be building any company on, and I think long term, that's probably not going to be a defensible competitive advantage that you can really sell to your shareholders and continue to deliver outperformance. I think we've been around for 7 years. We saw the market was going to get more and more competitive. So the way we built our company, whether that's our intellectual property of over 7,000 royalties, our technical management team, our deal sourcing networks in obscure countries, we built all of this to be defensible, to be differentiated, and to be competitive in 3, 5, 10 years' time. So we don't need to trade on a Franco-Nevada 2 times or 3 times NAV multiple to add value to our shareholders. We just need to continue finding attractive royalties and acquiring them at disciplined prices, with the right technical diligence, and that will consistently create value for our shareholders.
So what are you trading at versus your cash flow?
So we're trading at between 0.8 and 0.9 times net asset value. Obviously, the pullback post our financing probably puts us towards that lower end of the range. But we would expect that certainly how we continue to price deals, that we can continue adding value, acquiring new royalties at prices below that where we're trading.
Okay, so you think your model is sustainable, and you believe that you are. Do you think you're doing it better than others?
Look, I mean, we try and stay humble, Matt, and we think aspects of our business really are first rate and leading the industry. And I think our approach to using sort of a big data style disruptive model to actually, looking at, finding deals that others aren't aware of, whether it's buying a royalty from a telecommunications company or buying a gold royalty from a hearing aid company, things like this, leveraging intellectual property are very unique in our industry. And also back testing over 600 deals. Like there's not many people, we encounter are that obsessive about focusing on historical data and using that to, project returns going forward. So I'd say some of those aspects are, we would believe, cutting edge and leading the industry. But we, like any new company to the public markets, we've got a lot to grow on and a lot to learn, particularly in terms of our capital markets program.
Right. And given where you are today, you're sort of at the upper end of the small guys, right? You're $8,500 million kind of market cap, which is fine. But for us poor investors to look at this, large group of young royalty companies, the wannabes, you told us how you differentiate yourselves, but what can we expect from you in terms of timing? What's going to be that move that gets you to the next step, which gets you to be, I look at people like a Mavericks, right? They're kind of a size now. They've been around, they've done a lot of things right. But, there's less leverage up there. How do you get there?
Yeah, I think it's a question we ask ourselves, every week as management, Matt. I think in terms of proving our business model to the market, I think one huge catalyst over the course of this year is us demonstrating the cash flow embedded within our royalty portfolio. It's anyone can be a wizard on Microsoft Excel and project astronomical returns,
and they do
on royalties,
and they do,
and they do. But ultimately, we're for us to be able to re-rate and to show the market how much value we're creating with each royalty deal that we do. I think this year is a really pivotal year for us as that cash flow really starts to hit the bottom line and as the revenue really starts to come through from incremental royalties moving into production. So that's something that we're very excited about and excited to demonstrate that uplift to our investors.
Right. Are you going to build this thing out, or are you looking to be taken out?
We serve at the value of our shareholders, and look, management holds about 15% of the company. I've got 4 of my siblings are Vox shareholders, and I can assure you they are the noisiest of noisy in a positive way shareholders. So if someone came along with an offer that we felt presented fair value for our shareholders, we would obviously have to consider it. But we see a very clear path to us continuing to grow in a very disciplined fashion. And in 2-3 years' time, when the portfolio is really spitting out a huge amount of cash flow, and either we continue allocating that to value accretive deals, or we just start becoming a big dividend payer. So we see a number of different pathways forward. Each of them will be assessed against each other in the context of shareholder value.
Beautiful, Spencer. I appreciate your time. I'm just conscious probably gone on a little bit longer than I thought we would.
Sure.
I loved it. Some great answers in there. Stay in touch as you get on with this, working your way through these LOIs. I'm intrigued to see what you can do there. I'll definitely pick the phone up when you call.
Thanks, Matt, for your time today. I just want to leave you with these 3 thoughts about Vox Royalty Corp. 1, we are the fastest growing royalty company in the industry. We've done over 19 deals in the last 2 years alone. 2, we've built a truly unique and disruptive royalty company, which is centered around the world's largest proprietary royalty database that we've built. And 3, investors today are getting in at the ground floor. We've got exponential revenue growth expected from our existing 47 royalties, and a huge amount of really attractive and well-priced deals coming up as well.